So I'm going to talk about a couple of things today. Firstly, I'd like to speak quickly about US government bonds, but my main topic is going to be emerging markets. And I've recently placed trades based around both of these themes. So as I see it, after last week's jumbo cut of 50 basis points, as it's now being called, by the Fed, we now have, in my view, two bearish factors for the US bond market, which seems probably fairly counterintuitive. So let me explain. Firstly, alongside what everybody is recognizing as an aggressive rate cut, Jerome Powell emphasized that the top priority is preventing any further increase in unemployment, rather than trying to squeeze inflation down to 2% or less. This implies that the Fed's 2% inflation target is actually now a floor for future US inflation, as opposed to a ceiling as it was from 2009 until 2020. So, with some simple maths, if 2% is the floor for PCE inflation, the average over a cycle is likely to be around 2.5%. CPI inflation, structurally, is normally about 0.5% higher than PCE, implying that the Fed is now aiming for 2.5% as a minimum level for CPI inflation, and thus inflation will average around 3% over the cycle, even if the Fed is fully successful in hitting its target. Now, the difference between 2% and 3% inflation may not sound like much, but in financial markets, it's very important. Why? This is because the US bond market, which acts as a benchmark, don't forget, for valuations of all global assets, is currently pricing CPI at 2% for the next 5, 10, 20 and 30 years. In other words, the US bond market is underpricing US inflation by 1% annually across all time horizons, even on the most optimistic assumptions about the Fed's ability and or willingness to hit an inflation target, which, let's face it, it's missed for the past 4 years. So that's point number one. Point number two, second implication of the Fed decision. According to JP Morgan, for example, bond markets are now pricing a 70% chance of a 2025 US recession. With the jumbo rate cut and Powell's unequivocal promise to prioritize preventative action against any further rise in unemployment, surely this makes a recession next year much less likely. And that's even before taking into account the near certainty of tax cuts and or higher public spending, depending on who wins the presidential election in November. If Trump wins, you're probably going to get both, i.e. tax cuts and higher public spending. So without a recession next year, the Fed is likely to disappoint the bond market's expectation of a further 200 basis points or 2% of rate cuts, with Fed funds now priced at 2.8% in December 2025. Even the median projection of 3.4% for Fed funds at the end of 25 from Fed officials' summary of economic projections looks unrealistically low, now that the US economy is, let's face it, much more likely to avoid a recession. So, conversely, falling short-term interest rates, far from helping bonds, could actually coincide with rising bond yields because of what's already priced in, particularly at the long end, as the yield curve maybe disinverts and then steepens. So my trades, in the last couple of weeks, I've shorted both US 10-year treasuries and the TLT. What's the TLT? It's an ETF which holds long-term US government bonds. TLT recently reversed its move above 100 back under 100. This trade should also be helped if the US dollar weakens. And on that subject, interestingly, the dollar being strong is really slightly a myth. It's actually been quite weak for the past 2 years, except against the yen and the renminbi. It's actually down 12% from its 2022 high on the DXY index, the DXY being a measure of the US dollar's value relative to the majority of its most significant trading partners. It's down 13% over the last 2 years against the euro, 16% against the Swiss franc, 18% against the pound, and weaker than most major emerging market currencies. So more of which I'll be talking in a few moments. Now, this is not the consensus view, I've got to stress. So I've got here a chart of the DXY And this is part of the argument in terms of going long of emerging markets as well. So this goes back to 2014. And as you can see, if we just focus on the most recent time period, you see the spike in the US dollar with respect to the DXY back in 2022. And since that time, overall, against a basket of currencies and countries against which most of its trade is done, it's actually come back quite a long way. That's the first thing. That gives a tailwind for emerging markets. Secondly, here's a chart going back as far as 1980. We're not going to go back all that way in history. But what this chart shows you is that particularly since 2020, you've seen the dollar outperforming all of the other majors. And as I said earlier, actually peaking around the summer of 2022. Since that time, it's obviously come back a bit. You've seen the Swiss franc moving up gradually, and you've seen the euro basically not doing an awful lot. And clearly you've seen a slight rally in the pound. But of course, the standout there is Japan. Now, a lot of people have been calling the rally in the yen as now over. But what I would say is, if you look at this chart, if the yen is actually going to continue to rally against the dollar, it could actually theoretically go quite a long way further. So what's the idea behind my emerging markets trade? Well, emerging markets have been in the doldrums for well over a decade. If the US dollar is about to weaken further, emerging markets begin to look very interesting. A bit like China, investors and traders have all but given up on emerging markets. Chinese equities have been on a tear in the last week. I spoke about that and specifically Alibaba on my last flash recently, so I'm not going to repeat myself. However, another trade that I've been putting on in the last couple of weeks is long EEM. EEM is an ETF containing some of the largest Taiwanese, South Korean, and Indian stocks like Taiwan Semi, Reliance Industries, ICICI Bank, as well as Chinese stocks like Alibaba and Tencent. Now, indeed, there are purer ways to play this theme, but EEM is a simplified expression of the trade idea. It's currently trading at a 52-week high, but it's still significantly down from its 2020 highs. Now, interestingly, the total shares outstanding are at similar levels to all the way back during the global financial crisis. What that means is that money flow into the ETF hasn't anywhere near taken off, because if it had, you'd see the number of shares outstanding increasing. So this trade is about an inflection in those money flows. A further weakening of the dollar and or weaker US government bonds, the other trade, would cause inflows and therefore further upwards price action in the EEM. So apart from the US dollar DXY argument, why emerging markets? Well, at ITPM, on our Discord chats and with the students that we mentor, we talk a lot about tail risk trades. So just to make it clear, these are trades that are not the majority of our portfolios, but are trades whereby we see that if the idea comes to fruition, that we have an outsized risk-reward profile to the trade, hence why it's called a tail risk trade. So in some ways, long EEM, or emerging markets, is a tail risk trade, because at least as far as the consensus market view currently seems to be, so some emerging markets find themselves actually with better fiscal and monetary prospects than the US. So what I was thinking was, how might this fit into a tail risk trade? Well, a scenario for 2025 that certainly few seem to be discounting could be as follows. What if we actually got globally pent-up demand for labour, pent-up capital spending? Energy prices are still low enough not to restrain global growth. Corporate credit spreads are close to record lows. We've got central banks around the world lowering rates, increasing liquidity. The Fed and the PBOC both following easier monetary policies. We've even seen that in the last week or so. And what if the renminbi and the yen continues to go higher? Any one of those developments on its own could be reflationary, let alone all of those things together. All of these things give a tailwind to the EEM, emerging markets trade idea. So all of them together could prove to be highly potent at precisely the time that investors or traders have more or less given up on cyclical asset classes. Any of these factors would work for EMs, especially the cyclically exposed ones, for example, Brazil or South Africa. So what have I done? Well, in its simplest form, I'm long the EM ETF, but also being long out the money December 2024 or Q1 2025 EM calls versus short Octobers and then Novembers, etc. on a 2-to-1 basis makes a lot of sense to me. And as a senior trading mentor at ITPM, this is exactly the type of option structure that we teach our students to look for. Please don't forget that these positions form part of a diversified long-short trading portfolio. If you're interested in being mentored as a trader or require further information on our trading education, please just go to the ITPM website, itpm.com. And as usual, happy trading, everybody.